Hello, everyone. I'm very excited to be joined today by Kere Ezeji from Millicent Labs, and we are going to have a conversation about the nature of money, which I am very much looking forward to, and which is almost guaranteed to surprise most people. Kere, tell us a little bit about yourself and your background.
Thanks very much, Jana. I'm really excited to be here today to talk about the nature of money. My background is a little bit eclectic. I used to work as a journalist and then pivoted into the world of startups and went to business school, where I really fell down the rabbit hole of what money is when I read a paper from the Bank of England called Money Creation in the Modern Economy, which I suggest everybody listening to this reads. I found it very shocking and a bit scary at first, and it really got me interested in the nature of what money is and how it works in society and what it does for us. And that started my passion and got me to found Millicent Labs, where we build tools and infrastructure for the intersection of digital money and traditional finance.
I find it so interesting that that's the paper that inspired you to get into this area, because I actually only discovered that paper fairly recently, a few months ago, when it was recommended by a friend, because I have those kinds of friends these days. And shocking and disturbing are exactly the words that I would use to describe it. And the unforgettable words that banks don't take deposits and make loans. Banks create deposits through lending. But we will get into all of that through the course of this podcast. So let's start at the very beginning. We all think we know what money is. We all think that, money is what sits in our bank accounts. It's the cash that we use day to day. Most of us probably take for granted the idea that these things are interchangeable, that £10 is £10, no matter whether it's sitting in my bank account or whether it's a £10 banknote. But what is the difference between these different types of money? What's the difference between publicly and privately issued money? And what are the different types of risk that they represent to the end user?
Great question. I think that off the back of that paper that we mentioned, initially you want to be very scared, and then you read more and learn more about it, and you realize that there's a system that supports all of this. And I guess the base layer of this system of money is publicly issued money, which is created by the central bank. So in our case, the Bank of England. And the banknotes and coins that we use are a promise or a liability of the central bank that they will pay us the value of what's on that banknote. And the only form of public money that you and I can use is cash. So banknotes and coins. And there's also an electronic form of central bank money known as reserves, and that's only used by financial institutions to settle debts between them. And most of the money in society, I think here in the UK, it's 96 or 97% of the money that's used by the public is created by private banks, by private institutions, your high street banks, your Lloyds, your Barclays, your HSBC, that create commercial bank money. And I think that most people, when they put £100 in the bank, have a vision in their head of your £100 in notes sitting in a vault somewhere that's maybe going to be stolen by George Clooney and the Ocean's 11 guys one day. But that's not really the way that it works.
Tell us what happens when I take £100 in cash to a bank branch, assuming I can find one, and deposit it in a bank account. What do I then own, and what does it represent?
So when you deposit your money at the bank, you are essentially loaning your money to the bank to use as they see fit. And of course, there is a lot of regulation as to what they can do with your money. But essentially, banks borrow short and lend long. And so they borrow the money from you, the demand deposits that you give them, and they lend it out to other people in forms like mortgages, home loans, trade finance, etc. And they're able to do this in a fractional reserve model. And what that means is that if you give your bank £100, you have a claim to that £100 because the bank has a duty to you to return that £100 when you ask for it. But because they know that most of the time, not everybody asks for their money back at the same time, they might only need to have 20% of all the money that everybody gives them on hand, and the rest they can loan out. And it's a bit of an oversimplification, but the money multiplier effect is how this is often known, where if I deposit £100 at the bank, they might loan £90 out to other people who then spend it in the economy. And that £90 comes back into the bank, of which they again lend out 90%. So £81 goes back out into the economy and gets spent and comes back in. And as I said, that's an oversimplification. It doesn't work exactly like that. But at the end of the day, the banks create new money because every time they loan you £500,000 for a mortgage, the balance of that £500 is also created as a deposit in somebody else's account. So you as the buyer of the house get loaned 500 grand, but the seller of the house gets credited 500,000, and they've essentially created new money. And that represents 95+% of the money that we use every day.
So I take my £100 note to the bank, and again, assuming I can find a branch, and deposit it. And at that point, I no longer own £100. Instead, what I have is a liability against the bank, a claim against the bank, which is not backed by £100 sitting in cash. It's backed by maybe £10 of cash and maybe some other assets and some prudential regulation and a lot of, love and trust and faith and hope in the whole system. And the bank is actually going around creating money essentially on a ledger, we could say, because when it loans out money, it's not moving money from one account to another. It's just crediting an account with money it's made out of thin air.
Yes, more or less. And I think that something you said in there is really important, is regulation and faith. And those are kind of the glue of the modern economy. Is you've got an enormous amount of regulation around financial institutions, and that is really what gives us the faith, because this is all anchored in a system that is designed for the banks to be able to do this. So the banks are able to create this money out of thin air, as you put it, because we know that there's a lender of last resort at the end of the chain. And that singleness of money is really what holds everything together, and is really the reason why the Bank of England is looking into a central bank digital currency. And I think we can come back to that a little bit later.
Yeah.
But knowing that the £100 IOU that I have from my high street bank can be withdrawn as cash from an ATM is really the anchor that holds everything together, that gives us that kind of singleness of money, or the no questions asked principle. In theory, you might think that money from bank A should be valued differently than money from bank B based on the balance sheet of the bank or the financial performance of the bank, etc. Because an IOU from Apple is very different to an IOU from the convenience store down the road. But
the credit risk I'm exposed to from the bank, basically, yeah.
Exactly. But you can see that all of this has been homogenized because it's all anchored in the fact that you have deposit insurance up to currently £85,000, or as we've seen in the US, that the central banks will backstop the system and make sure that people like you and I are made whole.
Okay, so the role of public money in this case, the cash, is not only to provide us with a means of transacting with each other in public money, but also as an anchor of confidence and stability in the banking system. The knowledge that at any point in time, I can go to an ATM and I can withdraw money from my bank account, where it is a claim against the bank, into cash, which is public risk-free money. That's what underpins the whole system.
Yeah, correct. It's that singleness of money is underpinned by the public money, the fact that you can get hard currency backed by the Bank of England whenever you want it. And as cash disappears, that becomes more of a risk of losing that singleness of money. And I don't think this is something that people overtly think about, but it's the kind of thing that you take for granted and sits in the back of your head that, money from when I do a faster payments transfer from my bank to your bank, you don't think about the fact that, one bank has to delete numbers in their ledger and the other bank is writing in new numbers in their ledger. And at the end of the day, they transfer central bank reserves from one to another. You just think of money, and it's represented in your head, likely even when it's on a debit card or a credit card, you think of cash. And it's really that backing and faith in the central bank and the government that keeps the whole system together. That's the glue.
Okay, so moving along from the concept that basically all money is essentially a form of debt more than anything else, let's start talking about new forms of digital money and what they bring to the mix. So what we've been talking about so far is the monetary system as it works today. What are digital currencies? What are central bank digital currencies? What are private sector equivalents? Where did they all come from? What inspired them? And yes, tell us about that.
Yeah. So the first, I guess, when we say digital currencies as opposed to digital assets or cryptocurrencies, we're mainly talking about things that are blockchain based or tokenized versions of fiat currencies. And so I think just to lay that as a foundation for the rest of the conversation, digital currencies really started in 2014, 2015 with Tether, which was known at first as Realcoin, which was launched by the guys behind Bitfinex, essentially as a way for people to move easily in and out of a crypto trade. And up until that point, Bitcoin was the base pair for all of your cryptocurrency trades. So you would trade Bitcoin against Litecoin, Bitcoin against Ether, etc. But when the base of your trading pair is as volatile as Bitcoin, that adds an extra bit of complexity to your trading that is maybe not always wanted. As much as some people only believe in Bitcoin, it's quite easy to be able to move into dollars. And
because you want to be able to transact in something that's stable, to have at least one leg of your trade being something whose value you know and can rely on and is not going to be volatile and not move, so that you are buying and selling something else as an asset, right?
Yeah, correct. That's exactly correct. On-ramping and off-ramping, especially back in 2014, 2015, from fiat to Bitcoin, wasn't as easy as it is today. And many would argue it's still not that easy today. But on-ramping and off-ramping to digital dollars represented on the same blockchain, much easier, much faster. And so that's where these came about. But over time, they started to be used not only for trading, but for sending money from one party to another, sending money around the world, eliminating kind of expensive and costly remittance payments networks and correspondent banking system, providing, again, a stable store of value to people in countries whose currencies fluctuate or are devaluing. And so we see high stablecoin usage and high crypto adoption in countries like Turkey, where the currency has been devaluing for a number of years. And over a few years, people started to get more excited by this idea of digital native dollars, or as the guys at Circle like to say, uploading dollars to the internet. And we saw Facebook come out with the Libra and then DM project. And I think the idea behind that was that they would have a token that was backed by a basket of currencies and could essentially act as a one world currency. And Facebook, having 2 billion users at the time, really spooked a lot of central banks into taking stable coins much, much more seriously than maybe they had been up until that point.
So what was the central bank response to, I guess thinking about it, obviously Facebook introducing its own digital currency in use by its 2.3 billion users or whatever, not only represents a threat to individual sovereign currencies, because it's moving transactions away from them and therefore having an impact on central banks' ability to enact monetary policy and stuff like that. But it also has Facebook holding a basket of currencies of such enormous value actually has the potential to move currency values as well. So there are lots of risk and lots of concerns in there for central banks. So how did they react?
They reacted in the exact way that you would expect central banks to react, which is by putting their foot down and exerting all the power that they could to essentially put a stop to the project. And originally it was a consortium with some big players in the financial industry, but when they saw the regulators' reaction, these consortium partners dropped out one by one. And the Facebook moved the project from the States to Switzerland, which has kind of a more crypto-friendly outlook. And they really tried to rebrand it, saying they would do national currencies instead of this basket currency, but it was already more or less dead in the water. And the concerns over big tech having total control of money or being able to affect global financial policy and monetary policy and financial stability really put an end to that. But the central bankers woke up to the fact that cash use is declining, and since the pandemic has really fallen off of a cliff, and that they need to keep up with the Joneses in terms of this technological innovation. That if the central banks by and large aren't the most agile of institutions, that's not really their remit. They're meant to provide stability, not necessarily always innovation. But since that Facebook Libra DM moment, they've really moved into the innovation space. And we've seen now there are over 110 central banks representing more than 95% of global GDP working on a central bank digital currency. You've got the Bank of International Settlements innovation hubs popping up all over the world, doing a lot of experimentation. And we're seeing that they're preparing to have that same monetary anchor and be able to play the same role that they play today in a fully digital society, or a less cash intensive society, let's say.
I like the way we've kind of traced things from, the history of stable coins to Libra, to how it influenced the emergence of central bank digital currencies. And on that, taking that a little bit further, we often hear from the private sector. In particular, I remember a letter a couple of years ago that the American Bankers Association wrote to the Federal Reserve saying, you do not need to introduce a central bank digital currency. That's a terrible idea. We've got this. The private sector can handle this. And when we think about stable coins now, I think, the term stable coin 5 years ago was very useful in describing this kind of form of tokenized stuff that behaves like money. But now it's a very broad umbrella. It's almost used to describe everything from tokenized deposits, tokenized e-money, for example, which are regulated things and do preserve the singleness of money, like £10 of e-money or tokenized e-money is the same as £10 of deposit, or tokenized deposit is the same as £10 of cash. And then stable coins of the kind of traditional crypto nature, like Tether or USDC or things like that. What's the difference inherently between these things, and why are some of them money and some of them not? And why are stable coins not really that stable?
All very good questions, and it's all very complex. But to break it down into maybe a bit of more manageable bites, when we talk about stable coins, we can be referring to a number of different things, as you mentioned, but we've got algorithmic stable coins, which are backed by essentially a computer program and market demand. And we've seen that none of those have really managed to work very well. Terra's UST was worth, I think, $20 billion at one point when they were paying 20% interest on their stablecoin, and that collapsed and looked a lot like a Ponzi scheme. And we've seen other algorithmic stablecoins not really make it. There are also stablecoins which are built on a basket of assets, whether that's cryptocurrencies or stablecoins that are pegged to other assets like gold, for example. But generally speaking, when we talk about stablecoins, we're talking about fiat-backed stablecoins that hold or purport to hold $1 in reserve for each dollar of stablecoin that is issued. And I say dollars because I think about 99% of all stablecoins are denominated in US dollars at this point, which is a separate issue that maybe we won't have time for today, but we can talk about another time. But because the reserves behind these stablecoins are not always, let's say, fully transparent, and because they're regulated by different entities, and because they don't settle in that central bank money, their peg is free floating based on the confidence of the market in the value of their claim of their IOU. And so we saw, and also these things are traded on decentralized exchanges where there's no regulatory guiding hand there to help steady the waters when things start to go wrong. And so we saw even USDC, which everyone looks at as being the safest stablecoin, lose the peg when the Silicon Valley bank run happened, because 8% of their reserves were held there. And what was interesting is that should have stopped the value falling below about 92 cents in a rational market, because if they've got 92% of their reserves not in SVB, then even if the worst case scenario comes true, you should be able to get 92 cents for your USDC. But it went down to 88 cents. And that's because there's, markets can be irrational. But on a day-to-day basis, even the most stable of stablecoin can trade for half a cent or a cent above or below par on a regular day when there's no stress in the market. And that doesn't fit the singleness of money or the no questions asked. It means that if you're going to buy your morning coffee at Costa and you want to pay in stable coins, then Costa has to decide, do we accept USDC? Do we accept Tether? Do we accept BUSD? Do we accept DAI? Where do we draw the line? And that's kind of like trying to pay with your Barclays card and being told, no, we only accept Lloyd's money. It just doesn't really work. And we're finding that there's a power concentration happening where the top 3 stablecoins control about 90% of the market. And because they're not interoperable or fungible between issuers, that there's a real issue there, that it's going to be hard for the uptake. And part of that is because we don't have uniform stablecoin regulation yet. And another part is because they don't settle in that central bank money that's really needed to glue the system together.
So the singleness of money, that concept that, a Barclays pound is the same as an HSBC pound, is the same as a pound in cash, is ensured through bank regulation, basically, and also underpinned by the availability of cash and the fact that all of these things can be converted into cash. Is there a world in which, in the future, other types of stablecoins are also included in that singleness of money, or rather would they remain in the kind of periphery of things called stable coins while we see a greater emergence of essentially tokenized or digital native forms of traditional money like e-money and deposits?
I think almost certainly, and we saw that in the Bank of England's digital pound consultation paper that recently came out. And I think the Bank of England has had incredible foresight on the way that they're thinking about a CBDC. They're actively thinking about that anchoring of monetary stability, monetary policy, and financial stability. And they explicitly mention uses where stablecoins would be backed, perhaps one for one with a digital pound. So backed one for one with central bank money. And if that's the case, then you definitely know that I can accept this stablecoin because I have a claim for digital cash. Where
that's pretty much a synthetic CBDC, but
that is exactly a synthetic CBDC. Yeah,
it's kind of an odd kind of private sector distribution of something that sits on top of a central bank digital currency, which raises the question of why and what business model. But anyway,
yes, those are very good questions, but the platform model, the way that it's designed by the Bank of England, addresses some of the concerns that people have about, privacy or government control, because the Britcoin or the digital pound is planned to be distributed by the private sector. But yes, wrapping it and creating a stable coin that can, I don't know, maybe go onto the ETH mainnet and be used in DeFi. It's pretty interesting that you could then have a token on a decentralized network, permissionless network, that is a claim for £1. Now, how exactly
that is super interesting. Yeah. And actually I can see how that kind of concept would actually be, hugely influential in helping to build the digital asset ecosystem and the DeFi ecosystem as well.
Mm-hmm. Yeah, definitely. I mean, but then you run into problems that, a synthetic CBDC is very liquidity hungry. You don't have that fractional reserve model that allows the banks to create credit. And a lot of people, if you say that something risks disintermediating banks' business models, it's hard for a lot of people to have sympathy for the banks, because people look at banks as kind of the bad guy, but they're not in a lot of ways. We owe a lot of our economic growth and kind of prosperity in society to this model of credit creation, whereby you can get affordable mortgages and business loans where you don't have to go out and find somebody who's willing to lend you their £500,000 for 35 years, because that would cost a lot of money if you're looking in the private market. So the cost of credit is going to go up if you disintermediate this commercial banking model. And so I think that even though we will see a use for these wrapped CBDCs or synthetic CBDCs, that tokenized deposits, tokenized commercial bank money is going to play a huge part in the years to come. And it will need to be settled in hopefully some kind of wholesale CBDC. I think that would be the easiest and really help the ecosystem grow. But we do need tokenized commercial bank money to keep society working, to keep the structure and safeguards of today with the advantages of that digital currencies can bring. Let's put it that way.
To preserve that role that banks play in credit creation and in basically being engines of economic growth, whether we like that premise or not. It's the way things work at the moment. So one last question, and I want to take this back to the end user, who's probably the listener of this podcast. So in the future, I'm going to have the option of using cash, my normal commercial bank deposits, CBDC, maybe some stable coins, some other, tokenized deposits and tokenized e-money and things like that. How will I choose between these things, and what will my experience be? Will I have to be thinking about the risk that is associated with all of these things, and functionally will they be different? What's the impact to me as a consumer?
I think if the average consumer like you or I has to think about this when they're buying their groceries, that we've all failed. And that you need a system where we don't have to think about what is money. I think it's really interesting and it's great to know, and I will talk people's ear off at a dinner party. But the fact is that people have enough to worry about, and worrying about, is this £10 worth £10, or what can I do with this £10, that we've done things wrong. And I think that there are definite improvements in your everyday life that will be enabled, but it should be viewed as just another rail in which to spend money. And that money has a singleness to it. So right now I can send a faster payment, or I can use a Visa or a MasterCard, or I can use PayPal to pay online. But I don't think, okay, the PayPal money is e-money and the Visa and MasterCard is credit. And I don't have to think about any of this. I just send money to you via faster payments because it's easy. Or I use my debit card because it's convenient, or I tap my Apple Pay. And what we want to see are new, more interesting use cases where I can buy a newspaper article for 10p instead of having to subscribe to the publication for £15 a month. Where corporate treasurers, instead of using BACS payments that take 3 days to settle and cost 25p each, can set up programmable payments on a blockchain that doesn't even necessarily look like a blockchain, but it just makes things more traceable, instantly arrive, cheaper to send. These are the kind of powers that we want to unlock. Definitely think that unless you're a professional or a keen retail trader, if you're thinking about what kind of money you're using, something's gone wrong.
Thank you so much for that. It's been truly fascinating and a bit of a whirlwind tour across money, new forms of digital money, and the future of money. I'm sure we could actually do this for hours, and I'd love to have one of those dinner parties where we talk about this. But I think that's all we have time for today. So thank you so much for coming on the Poundcast. And I hope that all our listeners really enjoy it.
Thanks very much. Pleasure to be here. And yeah, hopefully see you at a dinner party soon.